My name is Luke Turner, and I'm working with Dr. Theresa Welbourne in the Management Department here at UA. My project is titled Evaluating the Impact of Pre-IPO ESG Disclosures on Long-Term Firm Success. I want to start by giving a brief introduction to ESG, environmental, social, and governance factors. These are non-financial factors that describe how sustainably a company operates. Environmental refers to how a company cares for the planet. Social is how it cares for its employees, customers, and the community, and governance refers to internal management and transparency. The modern idea of ESG can be traced back to a term coined in 1994 called the triple bottom line. This encouraged companies not just to prioritize profits, but also to equally consider the planet and people. And over the past few decades, ESG has evolved from simply a values-driven concept to a strategic one. Companies are pursuing ESG initiatives, not just because it's ethically right, but because it helps to attract investors. Investors are drawn to companies that are pursuing ESG initiatives and that are talking about ESG initiatives because they perceive these companies as being more resilient, better at managing risk, and better performers in the long term. And quantitative studies have helped back this up too. These have shown that ESG is linked to lower risk, and in some cases, even higher financial returns. However, the vast majority of literature in this area focuses on large, established public companies that already have long-standing communication channels with investors. So that begs the question, when and where does ESG disclosure actually begin? And does it matter in the very early stages of a public company? The earliest stage of a public company is the initial public offer, or IPO stage. And this is when a company transitions from private to public ownership through issuing shares. This is obviously a really important time for the company, but it's also really important for prospective investors, as they have to decide whether or not they want to invest in this company with very little information that they can access. However, the one document that they do have is the S-1 prospectus, which is a mandatory pre-IPO filing. It contains a detailed narrative about the company, its business plan, its strategy, anticipated risk factors, and if they choose to include it, ESG, either as a separate section or integrated into one or some of those other sections. Previous studies have linked ESG disclosures in the prospectus to positive increases in the short-term price of the stock. But there's been little research about how ESG disclosure can be linked to the long-term success of a firm. And that's where my research comes in. The question I'm trying to answer is, can ESG-related language in a company's S-1 prospectus predict its long-term financial performance following an IPO? To answer this question, I assembled a data set of all the companies that went public in the United States in the year 2021. I chose 2021 since it allows for a 4-year analysis timeframe. 2021 was also a particularly active year for IPOs, as there was a resurge after the COVID-19 pandemic. Overall, this data set contains 307 companies across 11 major industries. And you may see a few logos on this slide that you recognize, like Duolingo and Krispy Kreme. And all of these companies filed the S-1 prospectus. In terms of analyzing the long-term success, I decided on 2 key metrics. First is firm survival. Is the firm still listed on the stock market as of 2025? And then the second was the firm growth. By what percentage did the market value of the company grow from 2021 to 2025? And I used a logarithmic measure here to help standardize the data. In terms of measuring ESG disclosure in the prospectus, there isn't one standard measure to use, but I developed 2 variables based on text analysis of the prospectus. The first is ESG word percentage, which looks at the total words in the prospectus and what percent were words that had something to do with ESG. And then the second is a more broader view, which is ESG sentence percentage. What percent of sentences in the prospectus have something to do with ESG? I used a dictionary of ESG terms that has been used by several other papers to help decide which words were and were not ESG. I did want to note that what I'm not using are third-party ESG scores from providers like Bloomberg. Several other papers have used these in the past, but they differ widely between different score providers, and they also weren't available for many companies in my data set, since these are still early-stage IPO companies. Here's a more detailed look at how I did the text analysis. I downloaded each of the 2021 S1 prospectus documents from the SEC EDGAR database, which is an online, free, and publicly accessible database. I then wrote a Python script to read through each prospectus and count the number of ESG terms. And then I exported those word and sentence percentages in a document that could be used for analysis. On the other half of the slide, you can see two example quotes that were actually taken from prospectuses in my sample, so you can see how they were attributed to the different ESG factors. The first talks about employee morale, which would map into the social category, and the second sentence is about environmental costs and contamination, which falls under environmental. You may notice here, though, that these sentences are more talking about ESG risks rather than new ESG initiatives. However, this is still important because it shows investors that this company is concerned about ESG and is likely taking action to counteract these risks. After performing the analysis, I had a few key findings, and I first wanted to share two from the overall data set. First, I found that survival did not have a meaningful relationship with ESG. There were 256 of the IPO companies from 2021 that survived on the stock market after 4 years, and 51 did not. However, I didn't see a meaningful relationship between either of those ESG disclosure variables and the binary survival variable. But I think there is more exploration that could be done here, maybe looking at a more nuanced view rather than a binary one of how long each company actually did last on the stock market. However, I did see that market cap growth had a positive relationship with ESG sentence percentage. I found that ESG sentence percentage explains about 3% of the variance in post-IPO market cap growth. The effect is statistically significant given the sample size, but it is a small effect. I saw the most powerful correlations when actually looking at these companies on an industry basis. For example, I found that industrials, which consists of companies in infrastructure and water, safety, airlines, and manufacturing, had a very strong and positive relationship between ESG sentence percentage and market cap growth, with an R-squared of about 0.47. I think this is likely because the industrials industry has heavy safety standards and environmental impacts. And so the ESG language in the prospectus is actually talking about systems that are really relevant to the core business. And therefore, it's reassuring investors that this company can survive in this type of industry. I also saw positive correlations between consumer staples and energy industries, but both of these industries has very small sample sizes in my data set, less than 10 companies in each. So I really can't generalize these results at this point, but I hope to investigate these industries further with more data. Overall, I found that ESG disclosure in IPO filings does matter even at early stages, but it's most impactful when it's really rooted in the core business of the company. My results highlight that ESG signals aren't uniform. Their predictive value really depends on the industry context and the certain business model used within that industry. So some of my next steps include expanding the data sample beyond just the 2021 IPOs, looking into additional years as well, incorporating additional measures for ESG, maybe looking at some of the optional sustainability reports as well, and then identifying some additional firm performance variables such as stock price. And with that, I'm happy to answer any questions you have.
So you mentioned that 2021 was interesting. We're coming off of COVID. Maybe even you argue a little bit politically different, climate back then, and your future work was to look at other years. So what do you think there would be? Would you think there would be a difference between looking at IPOs next year in 2026, or is there any guidance you can give from your 2021 data that would help a company really highlight ESG strongly, or what would be your feeling, kind of intuition on that?
Yeah, I think that's a great question. I would definitely say that I've seen more news about ESG and maybe more kind of divisiveness about whether it's valued by investors or not, especially in kind of the current political climate. So I think I might see more kind of diverse results looking at future years. But I think another reason for looking at more years was also just simply to add more data to the sample so I can investigate some of those industries that had too small of a sample size to really investigate at this point.
Yeah, so I was wondering, are there any potential downsides of disclosing ESG practices as a company?
Yeah, I think that's a good question. There's obviously a lot of positive upsides I've seen, but I think kind of two potential downsides come to mind. First of all, companies obviously have limited capital, so if they're spending it on ESG initiatives and talking about that, that might kind of drive away some investors who are really only interested in companies that are channeling all the money into their core business. I think a second downside only comes if a company's talking about ESG, but not actually following through with what they're talking about, as that would lead to less investor trust and not more. So I think that's something that companies need to be aware of.
Do you have any knowledge of how the equivalent of IPOs work in markets in other countries? And is there such a similar concept as ESG? And you think that the results will be translated equally across those kind of concepts?
Yeah, I definitely, when I was kind of doing initial literature review, a lot of papers involve kind of European stocks in their research. And other countries, definitely thinking of Europe as an example, I guess even as a continent, is really kind of like diving deep into actually requiring companies to report ESG and has much stricter regulations. So I think there we might see even stronger correlations between companies might even have to be reporting and emphasizing ESG even to just survive on the stock market. So I think we're seeing kind of less adoption in the US, but I think that is growing kind of as seen in these results.